what about the business owners that makes a lot of money, makes a lot of profit, and like they're paying a lot of taxes right now, and they want to find the solutions to diminish or reduce that as much as possible, as fast as possible? What would you recommend in that area?
So a similar strategy, right? Like we're just going to use it maybe for a different reason now. If we have so much more cash flow, maybe we could fund a similar life insurance policy. Now the benefit to that is, so it happens in Canada, right? You have, no matter if you have associated companies to your operating company, which most people do, most people have a holding company that owns shares of their operating company, and they invest in their holding company thinking, I'm good, right? The second that you have more than $50,000 of passive income, you start to lose your small business deduction in Quebec, right? So I know you're familiar with it, but maybe for the audience, a 2-second bit on it. Once you make 150 grand in passive income, whether that's in your operating company or in your holding company, it doesn't matter, they're associated, you lose your small business tax rate, which results, we'll keep it simple, results in about $70,000 extra in taxes if you have the small tax rate. So you're paying 70 grand more in taxes. That's a lot. That's a lot. So how can we mitigate that? How can we potentially stop that from happening? Okay, well, have tax efficient investments or tax sheltered investments. Yep. And life insurance is a tax sheltered investment. So how much, we have to kind of figure out the calculation, how much of your investment portfolio needs to go into a life insurance policy to stop that tax drag on the small business tax loan and on your portfolio that's being taxed also. Because remember, your passive income, it's screwing up your your active business income, but you're also being taxed on that passive income at probably 50% as well. So you're losing a lot of that. So again, it's a similar strategy, and this is where we kind of get into the using the cash value potentially as an asset class. When you have that much funds and that much cash flow coming through, if we're able to maximize the additional deposit options, we can hit a break-even point on your cash value very early, as early as like 5 years in, and then use those funds to fund your operations, fund your lifestyle, or other things. So, give you an example, right? I'm just gonna make up a cash value number 10 years from now. So you have $1 million in cash value 10 years into owning the policy. What can you do with those funds? And why is it more efficient than an investment portfolio where to withdraw those funds you'd be taxed on? So if you keep money in the business, let's say it's for a business expense, you could just use your life insurance as collateral to a bank or even directly with the insurance company, and they'll lend you up to 90% of that cash value. So because it's a loan, there's no tax implications, right? So some people say, well, why don't I withdraw the money? Because if you withdraw the money, there could be tax implications. But if you use it as a loan and you put it up as collateral, and maybe if you have that much money, most likely you have a good relationship with a banker who might be able to offer you a good rate, and you could take money out into your company that way. Now, what if I want to get money into my hands personally, right? So that's the biggest problem that we see, and that's where the planning is really, really important. But it is one of the biggest problems we see is we have accumulated assets in our company for so long, and we've had success in deferring the taxes as much as we could, but at a certain point, I didn't just save all that money maybe to not spend it. I want to spend it. I want to use the funds. So using the life insurance, you can take the loan either into the company and pay yourself out a taxable dividend, which you're not really stopping the issue, but there's advantages to doing that. So I'll give you the two options, and I'll give you the advantages and disadvantages of each. So you either take money, you take the loan in your company, you pay yourself a dividend, or you pay taxes personally, right? So you've deferred tax in the company, it's great, but you still have to pay personal.